market adoption? And one way is it, like you said, carbon pricing, because that builds in an externality that the market doesn't necessarily take into account. So is that it? Is that how it works? Is that what you think the best approach is? It's that sort of carbon pricing
so
mechanism?
I'm going back here a little bit. So this is where this chart comes into play, you know. So I mean, carbon pricing is a powerful enabler, you know. So I'm just jumping here a little bit back to this part, you know. But maybe it's not enough. So this is the hypothesis of Saul Griffiths. I don't entirely agree. I think carbon tax or carbon pricing anyway, you know, as long as there is a price on carbon, whether it's tax or emissions trading, you know, it's important that it has this transitional effect, right? So that's what matters in the end. But he's concerned that it might not be enough. And I tend to agree that we need a very ambitious carbon pricing. For example, there's a proposal in the US, you know, where the price is suggested to start at a relatively low level, but increase by $10 per ton every year. Something like this, you know. This would be very, you know, ambitious, or it could even increase, perhaps it might even increase more. And the idea in the US proposal is also to use the income generated through this fee and distribute it as a dividend to households to make sure that households can cope with you know, price increases they might see, and actually have an incentive to change their behavior as well to save money in the end, right? So they would get this free dividend and use it as they see fit, and you know. So I like this idea in general of a fee and dividend too. But in addition to this, if you really want to speed up adoption, so this is what they suggest, you may need to have some kind of replacement mandate. So whenever a product reaches its end of life, you know, and you are looking to buy a new one, you're mandated to, you know, buy an electric one, right, or a sustainable one, a clean one. If your car is, you know, breaking down and you want to buy a new car, you have to buy an electric car, right? So this is, of course, a heavy hand that the market, that the state would, you know, promote. But it's not something that would be entirely unusual, or given the magnitude and urgency of the crisis. So, you know, you can compare it indeed with the situation where we have to mobilize for wartime. You know, this is the kind of collective effort needed at this time right now, or at least for the next, you know, decades. For the next 2 decades, we would have to do this. Yeah. So that's the argument, to use a combination of market forces, carbon tax, technologies helping us, and then give them an additional push through different kinds of policies. It doesn't have to be replacement at end of life. You know, working to this end in order to speed up market adoption.
Right, and so that what you're talking about is there's no one single silver bullet. There's, from the regulatory side, from the sort of market side, there's all sorts of different approaches.
They all have to work together, yeah, in the end, right? Yeah.
And I wonder if you could just spend 30 seconds critiquing Europe's emission trading scheme, because I know.
Yeah. I mean, I think it has been now around for decades, and you know, if you just look at the emissions reduction impact it had, you know, it's very you know, sobering, right, or disappointing, really disappointing. So the idea was good, perhaps in theory, and in practice it just didn't work. Of course, you know, industry lobby groups made sure to protect their interests and avoid you know, energy price increases that they saw. And so what happened in the end was that this emissions trading scheme you know, just didn't work. It kept prices didn't increase. So in the end, again, you know, whether you levy a tax, so there at least you have the certainty that you can control how the prices develop, or you try to, you know, limit supply, right, or in this case, you know, the volume of emission certificates, but either way, in the end, it's the price that matters, right, and the signal that it sends to the market, and the disincentives and the incentives that it creates. So if you're unable to control the volume, then you know, you will end up with a price that is way too low.
I see.
Yeah.
Thank you,
Young-jin. Hopefully it's changing in the future. Yeah.
Well, yeah. Young-jin, I know you've written a lot on this. I've read some of your articles as well. So I wonder if you just want to take 30 seconds to tell the audience where to go to read more on this, on what you've talked about, and other sources.
Oh, right. Oh, yeah. I didn't. I really didn't, put in my Medium website, but you can find me on LinkedIn. And of course, there's one last, call to action that I wanted to conclude with. If I had a little more time, so I'm just jumping to this here because I didn't cover the philanthropy side. But here, this is what you can do. So we talked about climate impact investing. There's a whole philanthropic side to this that you can also utilize, and what I think needs much more attention is pre-political giving, to support think tank activities, advocacy, lobbyism, and so on. But everyone can also become a net zero emissions organization or household and impact multiplier. A couple of organizations here that I can, for example, the Citizens Climate Lobby is promoting a carbon fee and dividend model. The Climate Reality Project is working on spreading urgency awareness. Fridays for Future, Extinction Rebellion, Climate Emergency Fund is one of the initiatives where they are similar to the Guerrilla Foundation. They are fundraising to support activism, which is very important too. Yeah, what I don't have here is now the link to my Medium page, but again, I think you can find me on LinkedIn easily. So happy to connect.
Perfect. Perfect. Thank you, Young-jin. Thanks for that fantastic presentation. And I know you're obviously you're very keen on speaking to people, so I'm sure people will reach out over the next few days. So thank you for that presentation.
Thank you for the opportunity, and have a great day, everyone.
Excellent. So now I'd like to move to Alex. Alex is an associate at the Dutch Infrastructure Bank, and he works a lot on the infrastructure side of the work that the bank does, and in their move towards renewables. If Giuseppe, if you can make me the presenter, then I can present Alex's presentation. Alex's presentation is a pre-recording, but he'll be live for the Q&A.
Good afternoon. This is a pre-recorded presentation for Sustainable Places 2020. My name is Pierre-Alexandre Hughes-Daly, and I am an associate in the Infrastructure and Renewables team at NIBC Bank. NIBC is a small Dutch bank based out of The Hague. We cover Western Europe, so that is Benelux and Germany, the UK and Ireland, and the Nordics. Our activities typically revolve around corporate lending, originating from our own balance sheet, originating and managing debt portfolios for institutional investors. Good afternoon. This is a pre-recorded presentation for Sustainable Places 2020. My name is Pierre-Alexandre Hughes-Daly, and I am an associate in the Infrastructure and Renewables team at NIBC Bank. NIBC is a small Dutch bank based out of The Hague. We cover Western Europe, so that is Benelux and Germany, the UK and Ireland, and the Nordics. Our activities typically revolve around corporate lending, originating from our own balance sheet, originating and managing debt portfolios for institutional investors, providing advisory, M&A, and equity or debt capital market services. And I guess as the infrastructure team, we've been very much focused on digital infrastructure for the past 4 or 5 years. So we've built a bit of a track record on that front and have seen probably most transactions in the market from the debt side anyways. Today we're going to look at digital infrastructure from the point of view of a bank or debt financier. What is digital infrastructure to us? Why is it such an interesting segment? We'll then move on to a brief market commentary looking at the past 4 or 5 years of underlying trends shaping these segments, followed by what I hope is an interesting Financing 101 introduction to how banks look at a fiber asset, what the typical terms you would expect to see for such an asset are, and sort of how we analyze the asset itself and then the transaction to sort of determine the viability of the proposition. Finally, we'll wrap up with a look at what the big trends and the big topics we see coming up covering digital infrastructure, and how the segment's going to be shaped in the years to come. Communication infrastructure and data centers are at the heart of a world that is digitally transforming. As an asset class, infrastructure has changed a lot in the past 5 years. Typically, core infrastructure would have covered transport, regulated utilities, energy. Digital infrastructure didn't historically play a large part of this. This has obviously changed, and as the pandemic has highlighted, we as an economy, as a modern economy, very much rely on digital connectivity and the cloud infrastructure. So it's very much becoming, if not quite yet, a fourth utility, probably in a certain way one of the most core utilities that we have. Economies just don't function anymore without digital connectivity. In our view, digital infrastructure consists of three broad segments, each subdivided into their own subsectors, of course, but breaking it down, we look at fixed communication. By that, we very much mean fiber, pure fiber, so full-on end-to-end fiber connectivity from the backbone to the home or the building or the premise. Wireless communication, which can be broken down into mobile phone operating network towers in urban areas, but also the towers beaming broadband to hard-to-reach, underserved rural areas. And data centers, historically more of a real estate play, but now very much seen as part of the digital infrastructure sort of ecosystem, if you will. Why do we see it as such an interesting segment? Typically, these assets benefit from stable, predictable cash flows. In the case of data centers, before the data center is even built, typically you'll have a 5 to 7 year contracted agreement for the provision of storage and processing services. In the case of fiber or wireless communications, there's a high stickiness to the revenues once the network is built and operational. If you think about it, how often do you change your internet or wireless service provider? It's a strong growth segment, and this is important, and we'll come back to this later on. Growth very much underpins the entire investment philosophy of the sector at the moment. In the case of fiber and wireless, we are still not at a point where these networks are really generating positive EBITDA, positive revenues, as we're still very much in the capex, so that is expenditure of capital to build the network phase. And in the case of data centers, the entire segment is underpinned by growing data consumption trends, growing cloud infrastructure, and need for further processing power in the years to come. So very much not even at the beginning, but just in the middle of the growth phase of the asset. It's a strategic niche market. Our economies are so dependent on the cloud infrastructure and the connectivity infrastructure today. It's hard to sort of think how our economies would function if we just cut off the internet or the data server access in the modern economy. And I think this has been very much highlighted by COVID and the shift to flexible working and working from home in recent times. We also see this sort of shift to the strategic view of the sector just from the words of government. The British government is very supportive towards the digital infrastructure, European Commission as well, German government full backing, and this is set to continue as people realize that actually they need a solidly built, highly redundant digital network. And finally, it's a quite resilient sector. Again, COVID sort of highlights this, but more generally, once these assets are built, they will generate utility and revenue and services for many years to come. Once a fiber is in the ground, it's the dominant technology and likely to remain the dominant technology for years to come. Same with a data center. Once it's been built, you have that data storage capacity. So quite resilient assets. Looking at data center activity, as mentioned, very much underpinned by a growing data consumption and data storage requirement trend. If we look from 2016 through to 2021, we're talking about a quintupling of data storage volumes. This more rapidly, as we sort of progress forward, is being also driven by big data. Big data has been a big trend for many years, but I think we're only just sort of starting to build that steam where people know what to do with big data. and thus storage capacities are very much being driven by that. Increased storage capacity requirement means increased data centers, more data centers need to be built, pardon. So that has driven data center M&A activity. If we look at H1, H2 2015 on the graph on the right, we see 25 transactions compared to 60 transactions in the second half of 2019. And that set is very much set to continue. In the latest numbers I've seen is that in 2019, 10% of all infrastructure spending, so that's the asset class as a whole, was on telecoms. Through the first half of 2020, that has gone up to 25/30%. So a substantial shift, and we expect that to continue. If we look at this slide, this one's quite an interesting one as it sort of highlights the journey, if you will, of infrastructure going forward. If we look at October 14, and the dark blue line, we'll see that the valuations, the multiples, were about 12 times. What does that mean? Well, it means that for every euro of EBITDA that your data center was generating, people were willing to pay 12 euros to acquire it. So at that time, those multiples have evolved over time. And if we look in October 2019, and the acquisition was a pretty big transaction from Equinix and Digital Realty, those multiples are in the 20s now. And this graph ends October 19, but based on what we've seen throughout 2020, those multiples are now at sort of 25, 26 times. That's quite high. That's a lot of money being spent on your assets. This has been driven by the huge amount of liquidity that's being poured into the sector as investors look for, one, positive returns, and two, stable, safe assets, especially think of the institutional investors which need to put their money somewhere. So you do start to wonder if at 26 times you're really getting value for your asset. Again, you get 4 or 5 bidders per asset every time a transaction takes place. I think there is still value there. I wouldn't panic yet. If we look at the light blue line, we see that the leverage ratio at around just under 3 times in October 14 has steadily, but not overly quickly, creeped up to just about 4 times leverage as of 2019. I think within the scope of infrastructure assets in general, a 4 times leverage is nothing to panic at. That's roughly as expected. So quite a healthy market, a lot of activity, a lot of liquidity, and quite a lot of deals being done, which is a good sign, especially in light of COVID. I think